All right, so recording in progress. Right. Okay. How do we start? Right now, again, day one of the boot camp, the new and improved boot camp. Right. I'm only going to be giving you guys the stuff that you need to know, like essentially on a need to know basics. Right. So while I will keep the older videos for you to go and have a look at, such as IBDR and all the other stuff that I've discussed in the past. This series, we will be, or I will be designing the boot camp, right, to prep everyone to think algorithmically, right? Now, earlier, it wasn't algorithmic, right? It was just normal stuff, how my experience with ICT stuff, right? But then as I kept on studying, I got to know the algorithmic nature of things. Okay, so when it comes to IPDA, right? When it comes to IPDA, right? We have so many things, right? We got a lot of things. We have the PD array, the PD array matrix, right? We got the PD array matrix. Then with the PD array matrix, we have stuff like interbank dealing range, right? We have interbank dealing range, we have CBDR, we have flout, we have Asian range, right? Then we have liquidity, we have, what do we have? We have high resistance liquidity, right? We have high resistance. And then we also have low resistance, right? We also have low resistance, right? So all of that, right? All of that is IPDA, right? Now, earlier, right? Earlier, I giving me or Sean giving you guys the information that I thought at that time you needed to know. I only gave you this one and this one. Okay. And as of recent, I started getting deeper into this one. Can you guys see my screen? My drawings? Yeah, right? Okay. So as of recent, I started getting into liquidity, high resistance liquidity, low resistance liquidity, and other stuff that I can't discuss on record. Okay. So that was our experience trading or working with the IPDA terminology, its ideologies and all of that. Okay. Its ideas and all of that. So that was how we started. Okay. That was how we started. So now, okay, now let's dig deeper into the basics, the very basics. Okay, there are four parts. There are four parts to this bootcamp. All right, one is going to be today's one, which is going to be speaking about liquidity. Okay, not many chart examples today. So liquidity, if the continuation cycle. All right, and then we have the IPDA reversal cycle. Right, we have the IPDA reversal cycle. So when it comes to liquidity, all right, when it comes to liquidity, we have, right, we have this. We have what? We have buy side liquidity, and we have sell side liquidity, right? We have sell side liquidity. So when we speak about buy side liquidity, right? Well, I've seen some people having their annotations wrong on their charts, right? You have a high, right? Above the high, you have buy side liquidity. You have a low. Below the low, you have sell side liquidity. Okay, below the low, we have sell side liquidity. So buy side liquidity is essentially, right, the stop losses of sellers. So stops of sellers, and buy stops of breakout buyers. Right, stops of sellers, buy stops of breakout buyers like Raja banks. Okay, then sell side liquidity. Sell side liquidity, what is that? We have stops of buyers, early buyers or whatever, buyers, and then we have what? Sell stops of breakout sellers. Okay, sell stops of breakout sellers. Now the algorithm, IPDA, right? It moves or it takes price, or for the lack of a better phrase, it reprices price into buy side liquidity pools, into sell side liquidity pools. All right. IPDA reprices into buy side liquidity pools and sell side liquidity pools. Now, the reason it reprices into buy side and sell side, or you can say all sell side, is because of its nature of doing what? We have the algo, right? We have orders coming in, we have orders going out. So the orders going out, right? What is the algo essentially doing? It's doing what? Can someone tell me? It's finding what? So there's a certain word for it. Starts with C. Yes. So it finds counterparty. Okay. It finds counterparty. So you have the algorithm. You have orders in. Okay. So you have orders in and you have orders out. Right. So you have buys going into the system, right? Buys going into the system. And then now the algorithm is taking those buys in the form of, moving price to find what? To find buy side liquidity. So we tie it up with them. Okay, and then reverse for sell side liquidity. Okay, reverse for sell side liquidity. We take the buys and then we reprice to buy side liquidity to find counterparty for those buys. Okay, to find counterparty for those buys. Now, here's the thing. When it comes to trading now, when if we move to the trading part of things, okay, here's what. Price, in order to reprice down, now listen up. To reprice lower, okay, buy side is required. Okay, to reprice lower, buy side is required. All right. Therefore, if you look at it on a line from a line graph perspective, all right, you have a big range like this. You have a high here. You have price going down. All right, and let's just say that it broke market structure here. All right. So now look, if let's say price has to reprice over here to sell side liquidity. Okay, in order to go down, someone tell me what will price do? Will it, let's say, let me give you two scenarios. Will it go to this and then drop, or will it do that? So is it scenario 1 or scenario 2? It's 1, right? It's scenario 1. I'll tell you why it's scenario 1. Scenario 1, it's because, see this breaking market structure, right? While we do have other concepts like, the change in state of delivery, breakers and all that, there are certain conditions that need to be met in order for them to actually work. Okay, but now just talking about it from a very generic perspective, right? We have buy side here, price will take out buy side and then reprice lower to sell side. Okay, so buy side to sell side, right? This is your what? Someone, what's the word for this? Taking out buy side liquidity and then going low. What's that called? Starts with I. Yeah. Inducement, right? Inducement. So that is what the algorithm does. Reprices higher in order to go lower. Okay, now think carefully. Reprices higher in order to go lower. Then, in order to reprice higher, all right, in order to reprice higher, sell side is required. Okay, in order to reprice higher, sell side is required. So what does that mean? That means that now if you look at this here, you have structure here, then you have that, right? That majority of the time, okay, majority of the time, you will see sell side purged, up we go. Okay, sell side purged, up we go. So it reprices lower. So number one, number two. Number one is what? Reprices lower for sell side. Number two, uses sell side liquidity to expand higher, right? So essentially, if you were to liken this to, let's say, if you were to liken this to a car, right? A car, and this is the petrol station or the gas station, right? The car has to come to the gas station, fuel up, and then only go up, and then only go to its destination. Okay, that is what sell side liquidity and buy side liquidity is used for. Yeah, GTR, GTR. Okay, that is what sell side liquidity and buy side liquidity pools are used for. All right, so that's that. Now, you know the types of liquidity. Okay, buy side, sell side. But what about the forms of liquidity, right? When it comes to the forms of liquidity, right, the forms of liquidity, you have high resistance, and then you have low resistance. Okay, high resistance, and then you have low resistance. So when we speak about high resistance liquidity, okay, so high resistance buy side, high resistance sell side, right? So high resistance, let's say high resistance sell side liquidity. It looks like this. Okay, this is your high resistance sell side liquidity. Right, high resistance sell side liquidity. Now the question is, what makes it high resistance? Okay, now for it to actually be high resistance, we need to see a break above this point, and then for price to come back down, right? Then the the logic behind this is this. Okay, it's pretty simple. Let me take this out first. The logic behind it is this: you have uh, a low, you have a low, and then you have a break of market structure. Now, classic retail ideas say that you need to have a low, you need to have a low, you need to have a high, you need to have a lower high, right? But now, here's the thing: you have a low, high, so you have a low, high, you have a low, but now you have a higher high, right? So this pattern is essentially useless. Therefore, what this is saying is, right? What this is actually saying is, no, it is highly resistant to going down. Okay, at this particular moment of time, let's say this is London Open. Okay, during this particular moment of time inside of London Open, gold, use gold as an example, gold does not want to go any lower than this specific region, or you can say it doesn't want to go any lower than the lower low. Are you with me? With me? You feel me? All right. You guys get me, right? What about the rest? Yeah. Okay. All right. So that's high resistance sell side, right? Now, what about high resistance buy side? So when we have a high resistance buy side scenario, let me take this out. Okay. High resistance buy side scenario is you have high, you have a higher high, and then you boom, you break down, right? Break down. Now, here's the thing. Classic retail, it's high, low, higher high, higher low, right? So You have boom, 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 right? But now you're breaking this pattern, boom, useless, right? Useless. You are then looking at this, okay? Looking at this. Now you have to think, fine. This is now, let's say, New York Open. Price made a higher high, fine. And then price broke market structure. What is it saying? What's the logic behind it? The logic is this. Okay, gold tried to go higher, fine, it went higher. But after it made that new high, it just broke down just like that. Now, if it's breaking down just like that, okay, what it's saying, what's basically happening is it's breaking that so-called trend, right? It's breaking that so-called trend. You're shifting sentiment, you are shifting order flow, right? You are shifting order flow. This pattern is a very good indication of a shift in order flow. And depending on the time frame, it can be a larger shift in order flow, or it can just be a shift in order flow for like 5-10 minutes, right? It could range from 5-10 minutes to an hour, 2 hours, 3 hours, to even one whole month, right? You see this pattern on the daily time frame, then obviously you're going to see down lower prices for like maybe a week or two before price changes again, right? So this signature in price, high resistance liquidity runs, right? High resistance liquidity signatures are signatures in price that you can infer a what? A reversal from, okay? Or a shift in order flow, right? Is everyone cool with high resistance liquidity runs? Yeah. All right. Then you have low resistance. Now let's look at low resistance buy side. Okay. So we have buy side liquidity, that is low resistance. All right. Buy side liquidity, that is low resistance. Fine. You have a high. You have a lower high. Price breaks down. Okay. Lower high, price breaks down. Now this here, right? This over here is a signature, okay, of continuation. Okay, it's a signature of continuation. What does that mean? It means this, okay? You have a high and you have a low high, right? But now see, in the first high, you have buy side liquidity. Second high does not take out that buy side liquidity, right? So what does that mean? There's more stops over here, right? So this is a layered pool of buy stops. Okay, layered pool of buy stops. So unless on the higher time frame there's like, you know, one big shift of order flow, right? One big shift of order flow that cannot be seen in the current time frame that you are looking at. Okay, this signature in price tends to get run almost immediately. So what do I mean by that? Look at this. Okay, so let's say you have a range like this, and price goes down. Then it creates a high resistance signature. So here, here, here. So now it makes it very easy for price to capitalize on this PD array over here and take out this low resistance buy side liquidity. Okay, take out this low resistance buy side liquidity. Okay, so this is low resistance, this is high resistance. If the price wants to break a entry, it's high resistance liquidity and will be low resistance liquidity. No, I get to the order block part tomorrow. Okay, but breaker, yes, high resistance liquidity. Yeah. All right. So buy side liquidity, low resistance. Now let's look at sell side. Now what I just said, you apply it to sell side liquidity. All right. So sell side liquidity. Let me take my pen again. All right. You have low, then you have higher. Okay. If you can form a trend line, that is low resistance liquidity. Trend line, this is low resistance liquidity. All right, low resistance liquidity. But now looking at low resistance sell side liquidity, all right, if you take an example, so you have this one, and now we drop. Here's your liquidity. Okay, here's your liquidity. Yeah, it's going to be, it's recorded. Yeah. Okay, so this is your liquidity. Here's your high resistance signature. Price comes and takes it out. So what this essentially saying is you have this signature in price, right? So even if price moves away from it, right, you can actually, how can I put this? You can actually expect, or you can actually anticipate for price, sooner than later to actually come down and take the low resistance sell side liquidity. So what this essentially saying is having low resistance sell side liquidity present in current price action gives you a very good setup. Okay? Having low resistance sell side liquidity inside of current price action gives you a very good setup. All right. Is everyone with me? Everybody with me? Okay. All right. Okie dokie. Now, here is the types of liquidity that we can see on the chart. You have uh, equal, you know what, let me just make it a bit nicer. You have relative equal highs. You have relative equal lows, right? Then you have trend line liquidity, Okay, so these are the four major liquidity pools that you actually have on a chart, right? So you can clearly see that relative equal lows, relative equal highs, trend line liquidity, they are all what? They are, someone tell me, they are what? Okay, so what are these? Yeah, stops or low resistance, right? So low resistance, or you can connect them. So low resistance liquidity. All right, so these are all low resistance liquidity, and ideal scenarios, right? In price action, those really explosive moves that you get, they all target relative equal lows, trend line, and relative equal highs, trend line, and relative equal lows. Okay, so that's the liquidity aspect. So now, with the understanding that, with the understanding of what the algorithm uses these liquidity pools for, we can then reasonably infer that whenever we want to take a trade, we want to keep our take profits at these liquidity pools to take part in counterparty delivery. Okay, that way you can maximize the number of pips or your risk to reward or whatever that interests you in that particular move. Okay, so that is liquidity placement. All right, then let's talk about continuation cycles and reversal cycles. So, and again, it's not renaming anything, right? It's all ICT. So ICT, we know that from its month one, right? Month one, we know that every the elements to a trade setup, right? So the elements to a trade setup is, number one, we have a consolidation. Number two, we have an expansion. Then we have a retracement, or we have a reversal. Okay. Then number four, we have, let's see, we have consolidation, we have expansion, we have retracement, reversal, or we have this one, that one. All right. So consolidation, expansion, retracement, or reversal. Then we have a reversal or retracement. All right. And then we move all the way back to the start. Okay. Then we move all the way back to the start. All right, so you guys get this, right? It's all month one stuff, so you guys know it, right? Yeah. Question mark, question mark. Yeah. Okay. All right. Then when we look at the continuation cycle, all right, when we look at the continuation cycle, here is the things that we want to be looking for in price action, right? So let's look at the continuation. So continuation cycle. All right, so continuation cycle is something like this, right? So we have the consolidation, expansion, retracement, reversal. No non-recorded stuff today, man. Bootcamp, no non-recorded stuff. All recorded. Okay. So can you give examples? The example is not clear cut, right? So you need to find that. The example is not clear cut. So you need to look at it on different time, like on different times, on different time frames, it will look different, right? So that's going to be your homework. I'll let you know what the homework is. All right, so continuation cycle. You number one, you have consolidation. Number two, you have expansion. Three, retracement. Four, reversal. All right, four, reversal. So number one is consolidation. Number two, expansion. Number three, you have retracement. And number four, you have reversal. All right, number four, you have reversal. So you can break this down into sessions, into times of day, and all of that, right? So this can be Asia, this can be London, and this can be New York. All right, so classic Asia consolidation, a London breakout to the upside, and then retracement giving you your New York continuation. All right, so that is the continuation cycle for the bullish side. Okay, for the bullish side. So now let's look at the bearish side. Okay, so bearish side, you have this one, we have consolidation, displacement out, which is your expansion, retracement, and reversal. Right, so you have consolidation, expansion, retracement, reversal. Okay, so your homework is going to be to actually investigate these cycles, because once you do, and once you incorporate things that you already know, for the guys that have been here for a while, once you incorporate the things that you already know, you will know that you can use SMT here, you can use SMT here, you can use SMT here, and you can use SMT here. You have 1, 2, 3, 4 trades inside of this entire cycle, right? What Mr. 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 Rhyme classifies as a daily cycle is in fact just as simple as this. You trade within the consolidation, you trade the fake out, you fade the fake out, and you trade the retracement, you trade the reversal, and then your cycle is done. This is what people are paying thousands of dollars for. Okay, based on this cycle. Mr. Rhyme, yeah, Mr. Rhyme from WWA. Okay, this is what people are paying thousands of dollars to actually get to know. And here it is, as simple as this. Okay, it is as simple as that, right? So now this is the continuation cycle. Okay, now do you guys get the continuation cycle? Do you guys get the continuation cycle? Yeah, what about the rest? After reversal cycle, that's all. Today was nice and short, but the homework is going to be long. Okay, all right. Okay, let me take this out first. Here we go. Okay, reversal. Now, the reversal cycle is essentially what we work with every day. Okay, did I take, you mean me? Timothy? Nah, I did not. I don't have any other course under my belt apart from ICT mentorship. Okay. Right. So reversal. Reversal cycle, right? Okay. Now reversal cycle, you have consolidation. All right. Consolidation. Then you have expansion here and boom, up it goes. Okay, up it goes. Now, consolidation, expansion, boom, up it goes. And then you have retracement into a reversal. Okay, retracement into a reversal. So here's your 1, 2, 3, 4, and then 5. Okay, and then 5. So what's number 1? Number 1 is someone. Okay, now you guys answer for me. Number 1 is what? Okay. Number 2 is okay. Number 3. Okay. Number 4. Okay. Number 5. Reverse. Okay. All right. Now I'll tell you something. Okay. Or rather, I'll ask you something. After number 5. Okay. After number 5, what does price do? Tell me. Very nice. Then 6th step is back to consolidation, and from there onwards you will get a what? You will get a continuation or a reversal again. Okay, continuation or reversal once more. That's all there is to it. All right, that's all there is to it. And again, now this is the bullish example. Now let's see if I can draw the bearish example. All right, bearish example. If 4 is retracement, is 4 not further expansion? If 4 is okay, so here, here, here. So 1, 2, 3, 4, 5. So consolidation here, expansion here, reversal here, retracement here, reversal is number 5. No, it doesn't work like that. Expansion always comes under comes after consolidation. No, it doesn't skip steps. Someone sent a message on the group. Yeah, no problem. Today's Zoom recorded. Can someone just tell him yes, please? Okay. All right. So let me do the other side. Other side. Oh, my battery is running down. Yeah, I'll make this fast. Okay. Other side. So we have consolidation, expansion, reversal, retracement, reversal. You have consolidation, expansion, reversal, and then what? Retracement, and then to top it off, reversal, right? So now here's the thing. Every time you open the chart, right, you will either be here, 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 or here. Any time frame. Every single expansion or every single movement in price that you see is occurring inside of a consolidation, expansion, reversal, retracement, or another reversal. So you either okay, and again, here's the best part, right? Here's the best part. Majority of your losses come inside here. This is where, oh damn it. Okay. This is where all your losses take place. Okay. This is where all your losses take place. You think it's going to go down, it goes up, right? Now, as it goes up, you're thinking to yourself, okay, it must be a continuation, right? So then you buy over here as it comes down. And then what does it do? It goes lower, right? So you need to understand on the higher time frame, okay? On the higher time frame, you need to see exactly where you are in terms of expansion, consolidation, reversal, or retracement, right? Either one of those. So inside of any one of these phases of price action, inside of a day, month, week, whatever it is, you will definitely be able to get 1, 2, 3, 4, even 5 trades, right? The lower the time frame, the more trades you have. Right, the lower the time frame, the more trades you have. But just because you have more trades to take part in does not necessarily mean that all of those trades will give you the certain pip count that you are looking for. While price will move, it might not move as much as you think, right? So always, that's why you always frame your trades on a higher time frame, right? That's why you always frame your trades on a higher time frame. So with that, today's theory is over, right? Here is your homework. Let me write down the homework for you. Take these out and let's go to the chart a bit to look at what's happening now, and then we can stop. All right, so I'm going to record the homework part as well. Give me a second. Okay. All right, so homework, right? You have to, okay, you have to backtest scenarios of creation and reversal cycle, right? Yeah, continuation reversal, right? So you have to backtest 30 scenarios of the continuation reversal cycle. So meaning 30 scenarios of continuation, 30 scenarios of reversal. All right. Then you have to, here's the best part, you have to front test with a before and after picture. Front test 25 scenarios of the continuation and reversal cycle each. Okay, so guys, write this down, please. Write this down. I'll be back in 2 minutes. Give me a second. Okay, right, and you have to document it inside of a PDF. Okay, store inside PDF. Right, store inside PDF. And then tomorrow, what we are going to be looking at tomorrow is what? ICT's order block theory. Right, ICT's order block theory, where we will be looking at the PD array matrix as well. All right, so I'm assuming you guys took note of this, pictures, whatever. Let's look at the chart now, and then we'll be over with this. All right. How do I take this out? Sure. Can you guys see my screen? The chart? Let me know if you can. Yeah, right. Okay. Front testing is looking at it live, and taking a screenshot before after. Okay. All right. So now that we got that out of the way, so we are done with it. Okay. So now you know what your homework is. Let me stop recording.